IAS 12 Video 1. In this video, we will be doing revision of what you know about current tax from your BEL 200 lectures last year as well as your FRK 201 lectures. So please make sure that you have that warm fuzzy feeling with regard to current tax before we move on to our deferred tax later. So this is the calculation that you are used to from BEL 200 to calculate the taxable income. So in this calculation, we start with our gross income, we make some adjustments, some income is exempt, so we have to take that out, and then we have some deductions, and that gives us our taxable income. Now in our SPLOCkie, in our statement of profit or loss and other comprehensive income, we calculate our accounting profit. Now between these two calculations, there are many similarities. Many items will be treated the same way for tax purposes than they are treated for accounting purposes. For example, the revenue. Revenue will be included for tax purposes as gross income, and it's also that same amount is also included in for accounting purposes in our accounting profit calculation. And the same goes for our cost of sales and many other expenses, where they will be allowed as deductions for tax purposes, and they will be also expensed for accounting purposes. However, some items are treated differently between these two calculations. For example, dividend income. Now, dividend income will be included in gross income for tax purposes, and it will be included in our income for accounting purposes. However, for tax purposes, it's an exempt income, so here it's deducted again. For accounting purposes, we leave the dividend income in our accounting profit calculation. So for tax purposes, dividend income is zero. It's netted out because it's added and then deducted as exempt income. But for accounting purposes, the full dividend income is included in our accounting profit. The next item where there might be differences between tax and accounting is, for example, a wear and tear allowance, where for accounting purposes we have a depreciation expense. Now these two amounts are not necessarily going to be the same. So therefore we might have a difference between what goes into our tax calc versus what goes into our accounting profit calculation. Another difference is our capital gains, taxable capital gains. So for accounting purposes or for tax purposes, we will only include 80% of that capital gain in our taxable profit, where for accounting purposes, the full capital gain is included in our accounting profit. So if we now compare our tax calculation to our accounting calculation, we see that there are differences. But there are also many similarities. And so many items which are treated the same way for tax and for accounting purposes. So if we now put amounts to these calculations, what we do in practice and what you are going to do in FRK 300 is we are going to start with our accounting profit and then make some adjustments to that to get to our taxable profit. Okay, so for accounting purposes, for FRK 300 and out there in practice, because there are so many items that are treated the same way for tax and for accounting, it doesn't make sense to start doing the calculation from the top down completely to get to our taxable profit. So that's why what we do is we start with our accounting profit and we only fix the items that are treated differently between these two calculations. So we start with our accounting profit and we adjust that to get to our taxable profit. So for example, if we now have to do this calculation, this is our current tax calc. It's just a calculation. We don't disclose it anywhere. It's just the calculation that we do to calculate what our current tax expense is for the year. We start with our accounting profit and then we make some adjustments to that. So the first adjustment that we need to make is to deduct the dividend income. Because remember, we said that for tax purposes, the net effect is 0. It shouldn't be included in our taxable profit. But for accounting purposes, it is included in our accounting profit, which is the starting point of this calculation. So therefore, we now have to deduct it to get rid of it. Next, we add back the depreciation expense to eliminate the depreciation expense that's included in our accounting profit. And then we deduct our wear and tear allowance. Then with regard to our capital gain, we again get rid of the accounting treatment, which is to eliminate the R1,000 capital gain. So we deduct that. It was added to get to our accounting profit of 2,600. So now we have to deduct it. And then we add the 80%, which is the taxable portion of the capital gain. So we could have also, with regard to the capital gain, we could have also just deducted 20% because we have 100% but we only want 80% in our calculation. So we can stick with 100% that's included in the 2,600 and only deduct the 20%. So that would have been another way of adjusting our accounting profit to get to our taxable profit. So now that we have our taxable profit, we can now go and calculate what our current tax expense for the year will be. Okay, so let's put this into practice. Here we have an example. FRK 201 Limited's accounting profit for the year ended 31 December 2020 is 470,000 Rand. But this is after taking into account dividend income of 10,000 and fines of 20,000. On the 1st of January 2020, the entity purchased manufacturing plant for 700,000 Rand. The manufacturing plant is available for use as intended by management and taken into use immediately. Depreciation is calculated at 10% per annum on the straight line basis, and SARS allows a wear and tear allowance over 7 years. And we assume a tax rate of 28%. So if we now take this information and if we are asked to calculate the current tax expense, then what we do is we start with our accounting profit. We make all the necessary adjustments in order to get to our taxable income. Taxable income, we multiply 28%, and that gives us our current tax expense. Now please pause this video here and see if you can calculate the current tax expense. Okay, so there's our calculation of the current tax. We start with our accounting profit. We have to deduct the dividend income because remember it's an exempt income for tax purposes. We have to add back the fines because we can't deduct that for tax purposes. We can't get a benefit from driving over the speed limit or whatever it was that we got the fine for. We add back the depreciation, so that was 10% of the 700,000, and we deduct the wear and tear, so that was the 700,000 cost divided by the 7 years. That gave us our taxable income, which we multiply with 28% to give us the current tax expense of 126,000. Next, we are asked to do the journal to account for the current tax. So what will the journal look like? We have a current tax expense here of 126,000, so we will debit the income tax expense account to the P&L and credit a liability called current tax payable. Now note that here we have the current tax, and it's the current tax expense, but we put it to an account called income tax expense. And what you'll see later is that this income tax expense consists of more than just the current tax. So, but our starting point for our income tax expense is the current tax for the year of 126,000. Next, we are asked to present and disclose the current tax in the financial statements. So we are going to present it on the face of the splokkie, and then we are going to disclose it in a note. Now, please, again, note that this is just a calculation. This calculation should not be shown on the face of the splokkie or in the note. It's just a calculation. So here we have our presentation and disclosure. So in this, on the face of the statement of profit or loss and other comprehensive income, our splokkie, we have the income tax expense, which is the 126,000 that we calculated. So there's our profit before tax, less the income tax expense, and that gave us our profit for the year. In the note, what we have is we have our current tax for the current year of 126,000 Rand. What happens if we have a tax loss? So now we had a taxable income and we did the journals for that and we presented that and disclosed that. But what happens if we have a tax loss? So if we change the information in this question so that we start off with an accounting loss and we still make the same adjustments that we did in the previous example, we end up with a tax loss. Which if we take 28% of that gives us then this negative 14,000. So what do we do now? What will the journal look like to account for this now? Do we just do the same journal that we did previously, just the other way around? So creating an income tax income and then creating an asset, a current tax receivable asset. So saying, hey, Sash, you owe me money. I made a loss. You owe me money. Is this what we do? And then do we put it into our note here for current tax for the current year as an income amount? No, we do not do this. So I'm not suggesting that you will be hit by lightning if you do this. However, please, when there is a tax loss, we do not do a journal for current tax. However, you might think to yourself, okay, but there will be a benefit to us in the future with regard to this tax loss because we know that the revenue services will allow us to use that tax loss next year when we do start making profits, and then we will pay less tax. So yes, there will be some economic benefits, and we actually might have an asset, but it's not current tax. So that's why I'm saying here to be continued, because we will, when we get to deferred tax, you'll see what we do with this tax asset. But please, for current tax, no journal. Okay, and don't show me a current tax income in the note. Please, there will be marks deducted for that as principal errors. Okay, so what if we now had a 28,000 over provision for current tax for the prior year? So in the prior year, when we did this journal in 2019, remember this is now the 2020 journal, but when we did this journal in 2019 based on the 2019 current tax calculation, we actually had an over provision. So we provided for a too big amount of tax. We actually in the end only had to pay 28,000 Rand less than what we provided for. So what do we do now in 2020 if we have this situation? Okay, so we'll do a journal to say, okay, now whatever I had in that account for SARS as current tax payable, I can decrease that. So I'm decreasing the opening balance of my current tax payable because I actually owe SARS less than I originally thought. And then the other leg of the journal is then goes to income tax expense as a reduction of my income tax expense. Okay. So what will our presentation and disclosure look like now? Here we have our current tax for the current year, the 126,000, and here we have that reduction of the current tax due to over provision of the prior year of 28,000. So this is the 28,000 that we over provided in the prior year, and therefore it's reducing our current tax in the current year. So the net of that, the 98,000, is the amount that is shown on the face of the statement of profit or loss and other comprehensive income. Okay, so that's it for our revision of your FRK 201 and BEL 200 current tax. So this is just I just touched the surface there, just to show you some of the basic principles. Please go and have a look at your notes from last year for current tax, and make sure that you are comfortable with that. Make sure you get that warm, fuzzy feeling before we move on to deferred tax.